Well, there's been a bit of argy-bargy on the share markets in America over this last week when a bunch of day traders set to take on Wall Street, particularly the hedge funds who were shorting stock on Gamestop, amongst others. Well, for a day or two, it created uncertainty across the broader share market, but it didn't take long for things to bounce back. So was there anything wrong with what they did or how the Robinhood retail platform responded when they stopped any more buying of shares? Who were the good guys and the bad guys in the Redditt Rebellion? I'm Phil Dobby, and we'll look at that today on the Debunking Economics podcast with Professor Steve Keen. Welcome along. So what about this Reddit forum taking on the hedge funds, the Wall Street Bets forum on Reddit, which has gone from, incidentally, 1.5 million followers to 5 million in pretty short order, and they drove up the price of GameStop shares, which had been around $88 to $470 in just a couple of days, and then it fell to around $300. I think it's still quite a bit more than that original $88 value, so it stayed overvalued, you'd have to assume. Maybe time for a bit more short selling to go on. So can you beat Wall Street, and should you, is the question we're asking you today. Steve, we spoke about short selling a long time ago on this podcast, and you actually defended it. You said it was actually, you thought it was good for price discovery because it brings overvalued stocks back to where they probably should be. So do you still hold that view?
No, I mean, I've got a slight sympathy for short selling. I don't see them as, people who should be exterminated, which is the attitude that some market commentators and some share owners as well, of course, have towards short sellers. But to me, what I should want happening on the stock market is raising new capital for new ventures, and that's the last thing that actually happens with the market at the moment. And the short selling is just a correction for the well, not even a correction. It's a battleground between the bulls and bears over different stocks.
Yeah.
And it's moderately useful, but it'd be far more useful if we abolished the whole, or not abolished the whole bloody lot, but made the secondary market secondary to the primary market, when the primary market barely even gets a breath on Wall Street days in terms of raising capital for new ventures. Yeah,
absolutely. And we've spoken about that a lot, haven't we, as well? You know, the people feel like they are helping a company. In fact, on that bulletin board, I read one comment from someone saying, that the hedge funds are bringing down the value of these companies, and that is meaning lots of people in those companies will be out of work, which of course is not the case because it's a secondary market. It's going to make no difference whatsoever to GameStop.
Absolutely irrelevant unless they've got some of their own shares they can sell back into the market. Yeah, and it's all one speculator fighting against another speculator. And what I like about it is it makes a total mockery of the way that neoclassical economists look at the market, because one of my favourite pieces of delusional bullshit and the history of economics is this quote from William Sharpe, who gave us the capital assets pricing model that says that effectively markets are efficient. Markets find the right price for everything. And he built this typical neoclassical, moderately elaborate model of an individual investor who had preferences for returns, which of course is a good, but against risk, which is a bad, and therefore you put your indifference curve between the two goods in a different shape to you when you look at apples versus oranges. And then he had an idea of a risk-free asset as well that you could buy, and then you could have leverage or not have leverage, yada, yada, yada. Great model of one person. Then he had to extend it to the entire economy, and he said, I will assume, quote, from this point on, homogeneity of investor expectations. Investors are assumed to agree on the prospects of various investments, the expected values, standard deviations, and correlation coefficients described in part 2, end quote. In other words, he fantasizes that the entire Reddit thing is impossible because everybody agrees with everybody else and there's no price arbitrage whatsoever, which is complete utter crap. And that's wonderful to see this particular episode showing what actually goes on stock markets, but making it accessible to the public as well.
But I'm sure, a lot of people would say, well, okay, this is fine. All it's doing is demonstrating the market working, and it doesn't really matter who's buying and who's selling, whether it's Wall Street or whether it's Reddit goers, Reddit forum subscribers having a go. They are correcting a market imbalance. So, GameStop shares probably were too high. They certainly were after this episode. But I mean, if you look at the share price generally in the US, I mean, the market is overvalued, surely. So it has to be brought back down somehow.
But this was actually going the opposite direction.
Exactly. Yeah, to try. Yeah, because they were taking on the short sellers. Exactly. But so you could say, well, the short sellers, which I think is sort of my point. The short sellers are actually doing some good. They were trying to bring the values back down again.
Yeah, well, I mean, what they were looking at was a company which was losing money. I mean, it's what's it called? Gamestop.
Yeah.
Interesting combination rather than GameShop, Gamestop. And it was literally starting to stop because for a start, it was going down anyway because people were buying their games online. So you didn't actually need a physical retailer to go to unless you wanted to buy, extra little R2D2 widgets to put around.
Not entirely sure. I mean, they were just on that. I mean, you can get back to your point, but on that, I mean, people are still buying discs. I mean, the fact that the latest Sony PlayStation, they're selling many more units where they've got a disc drive, and part of the reason is that because you've still got to give presents to people. Otherwise, it's got to be something you can buy for your kids. Otherwise, you'll just be giving them money, and then Christmas is just going to be a period
of CD-ROM or with the CD.
Yeah, with the CD. Yeah, so kids are still using them.
A DVD.
Yeah.
Okay. Yeah,
but anyway, but your point is that this company was, but by and large, losing value though. So
and it's losing money, but apparently it wasn't losing as much money as the Wall Street mob thought. I mean, apparently it's still getting a reasonable cash flow, but of course the pandemic gave it a good kick in the proverbials. Which damaged its cash flow again because people weren't going out to buy anything, let alone games.
Yeah.
So that then meant that they were looking at it and saying, well, it's got to continue going down, so we'll buy it now and buy it back later at a cheaper price and then make a profit profiting the difference. And that's meant that they're exposed. They were short selling. And one thing which I haven't looked into this deeply enough to know whether it's true or false, but I saw that there were more shares short sold than there actually were in existence. Apparently.
130%. Yeah. Exactly. So they're completely overexposed themselves. So they deserved some sort of reaction to that, didn't they? So again, you could say, that is the market reacting. Somebody oversteps the mark, someone picks them up on it, and things come out in the wash.
Well, this is where it got to be real fun, because when you have people who've taken a position in a company which is correct. I mean, this is Keynes's comment about there's no point buying a share which you properly believe is going to be worth 40 in the near future when the market believes it's actually going to be worth 20 in the near future. Okay, so you call it a beauty contest where you're not trying to find the most beautiful woman or the person that most people think is the most beautiful person. You're trying to find the person that most people think other people will think is the most beautiful person.
Not the way to choose your marriage partner, by the way, unless you've got real problems. Look, if you want to hear the full version of this podcast, then you need to become a supporter on Patreon. Go to patreon.com/Prof Steve Keen, or you can subscribe at debunkingeconomics.com and you'll get access to the full version of this and all the other podcasts. And there's loads of them now. Back again next week. We're going to talk about zero growth. In fact, negative growth economies. Is that what we need to do to save the planet? And if so, how do we do it? Join us next week for that. I'm Phil Dobbie. Thanks for listening.